Listen to me very carefully. In my 40 years in banking, from the trading desks at JP Morgan to managing institutional dividend portfolios worth billions, I have watched the same cycle play out over and over again. The crowd piles into the same overpriced names, the same trillion-dollar darlings, and they wonder 6 months later why they are sitting on 3% gains while the real money moved somewhere else entirely. Right now, as we speak, the biggest wealth transfer of this decade is unfolding not in the stocks trading at $400 or $700 a share. It is happening in the overlooked, underpriced names sitting under $20 that most retail investors will not even glance at until it is too late. I am Marcus, and this is Invest with Marcus. Today I am handing you the exact kind of blueprint that we used inside the major firms when we wanted to position a portfolio ahead of a massive sector rotation. Not after the move, before the move. If you are new to this channel, hit that subscribe button right now and turn on notifications. This is not entertainment. This is financial education built on decades of real institutional experience. And if you are already part of the Marcus community, drop a comment below and tell me what is sitting in your portfolio right now. Let us build together. Now, before I reveal these 5 names, I need you to understand the macro landscape, because that is how professionals invest. We do not pick stocks out of thin air. We read the terrain first, then we deploy capital. And the terrain right now is telling a very specific story. Here is what is happening. The large-cap defense contractors, names like Lockheed Martin and Raytheon, have had an absolutely monster run. Lockheed surged over 40% in just 6 months. RTX posted record backlogs north of $268 billion. These are phenomenal companies, but when you see a stock like Lockheed Martin jump 31% in a single month the way it did in January, you know exactly what comes next. Profit-taking. Sector rotation. The institutional money that rode that wave up is now peeling off gains and redeploying into the next wave of opportunity. Where is that money going? It is flowing into smaller, high-growth names in adjacent sectors. Space technology, urban air mobility, autonomous systems, digital infrastructure. The very sectors where the United States government is actively picking winners through pilot programs, defense contracts, and strategic investment. At the same time, the Federal Reserve is holding rates in a range that punishes savers and rewards risk-takers who know where to look. Inflation is still sticky enough that the dollar is slowly losing purchasing power, which means sitting in cash is a losing strategy. You need exposure to real growth. And the names I am about to share with you are positioned directly in the path of that growth. But let me be crystal clear about something. I am not here to hype you up with penny stock fantasies. That is not how we built wealth at the major firms, and that is not how we build generational wealth in this community. Every stock I am about to discuss has a real business, real catalysts, and a real reason for being on this list. I will also tell you exactly where the risk is, because that is what an honest advisor does. Let us start with stock number 1, and this is the name I believe has the strongest fundamental foundation on this entire list. SoFi Technologies, ticker symbol SOFI, currently trading right around $18 a share. Now, I have been watching this company for a long time, and what SoFi has accomplished over the past 2 years is nothing short of remarkable. This is a full-stack digital financial services platform. They offer lending, investing, banking, and now they are even pushing into stablecoin territory with a recent MasterCard partnership. That is the kind of strategic positioning that tells me the management team understands where finance is heading. Let me give you the numbers, because the numbers do not lie. Full year 2025 revenue came in at $3.58 billion, a 35% jump over the prior year. They added 1 million new members in the fourth quarter alone. Deposits hit a record $37.4 billion. Loan origination surged 46% year over year. And here is the part that gets my institutional radar firing on all cylinders. The company is now profitable. They crossed that threshold. Once a high-growth fintech crosses into profitability, the valuation re-rating that follows can be explosive. This is trading at a forward price to earnings ratio that, in my professional opinion, does not fully reflect the growth trajectory. The risk? Valuation is already stretched by some traditional banking metrics, and if the Fed reverses course and hikes rates aggressively, that could pressure their lending margins. But at $18 a share for a company growing revenue north of 35% annually with a rapidly expanding user base, this is exactly the kind of name institutional portfolios are quietly accumulating right now. Analysts have a consensus price target just above $26, which represents roughly 43% upside from current levels. In my 4 decades in this business, that is a setup I pay attention to. Stock number 2 is Joby Aviation, ticker Joby, currently trading near $10 a share. Now, this is where we step into one of the most transformative technology sectors of the next decade: urban air mobility, electric vertical takeoff, and landing aircraft. If that sounds like science fiction to you, I need you to wake up, because the White House just selected Joby for its eVTOL integration pilot program across 10 states. That is not a press release from some speculative startup. That is the United States government saying, we believe this technology is ready for real-world deployment in 2026. Joby is backed by Toyota, which tells you something about the manufacturing credibility. They have $2.6 billion in liquidity after recent capital raises. They just secured a 700,000 square foot facility in Dayton, Ohio, to scale production to 4 aircraft per month by 2027, and they are targeting FAA certification for their first production aircraft this year. The company also has a partnership with Uber for air taxi services launching in Dubai. Revenue jumped from essentially nothing to $53 million in 2025, and the trajectory is accelerating. Here is where I put on my risk management hat. Joby is still pre-profitability. They burned over $900 million in losses last year. The share count has been diluted through equity raises. FAA certification timelines can slip, and geopolitical risks in the Middle East could delay their international launch plans. This is absolutely a higher risk, higher reward position. In my banking days, we would size a position like this carefully, maybe 2 to 4% of a growth allocation, because the potential payoff is substantial, but so is the volatility. 7 analysts currently rate the stock as a hold with a price target around $13.43, suggesting roughly 31% upside from here. Stock number 3 is Redwire Corporation, ticker RDW, trading around $9 a share. This is a name that most retail investors have never heard of, and that is precisely why I am bringing it to you today. Redwire is a space and defense technology company that provides critical infrastructure for both government and commercial space missions. Their technology is currently operating on the International Space Station. They build robotic arms, solar arrays, 3D printers for space, sensors, and autonomous systems. They were part of the $151 billion Golden Dome missile defense contract award, and they recently opened an 85,000 square foot facility to expand capacity. What makes Redwire particularly interesting right now is the confluence of 2 massive spending cycles. The space economy is growing rapidly, and the defense budget is expanding at a pace we have not seen in decades. President Trump's proposed $1.5 trillion defense budget by 2027 is a tailwind that hits Redwire directly. Revenue grew over 10% in 2025 to $335 million, and the company is guiding for up to 41.6% revenue growth in 2026. That is not a typo. Analysts have an average price target around $12.67, which is roughly 39% above the current price. Truist just upgraded the stock to buy. The risks are real. Redwire posted a net loss of $272 million in 2025. Free cash flow is negative. The balance sheet carries some debt, and defense contracts can be delayed or restructured. This is a small cap at about $1.8 billion market cap, which means volatility will be significant. But for investors with a 3 to 5 year time horizon, Redwire offers exposure to two of the most powerful spending themes in the global economy at a price under $10 a share. In 40 years of managing money, I have learned that the best time to buy these kinds of names is when nobody is talking about them. Stock number 4 is Archer Aviation, ticker ACHR, currently sitting near $6.35 a share. Now, I mentioned Joby as one eVTOL play, and Archer is the other serious contender in this space. Their midnight aircraft carries 1 pilot and 4 passengers, travels up to 100 miles on a single charge, and hits speeds of 150 miles per hour. The company has an indicative backlog of $6 billion with customers, including United Airlines, Japanese carrier partnerships, and multiple Middle Eastern operators. The FAA just announced eVTOL pilot programs, and Archer was included alongside Joby. That is critical validation from the regulatory side. They have a manufacturing partnership with Stellantis, one of the world's largest automakers, which handles their contract manufacturing. And just recently, Archer signed an agreement with Serbia to become the country's preferred eVTOL provider. But let me give you the straight talk. Archer has only produced 2 aircraft as of now. Revenue in 2025 was a mere $300,000 against losses of $618 million. They missed their own production targets for 2024 and 2025. The stock has fallen over 55% from its 52-week high. That kind of decline tells you the market has lost patience, but it also means you are getting a potential future leader at a deeply discounted price if they execute. Analysts still have an average price target around $11.60, which would represent roughly 83% upside from current levels. The risk-reward is asymmetric, which is exactly what we look for in growth allocations at the institutional level. Size it appropriately. A 1 to 2% portfolio position at most, because this is a name where conviction must be matched with discipline. Now, stock number 5, and I want to be completely upfront with you. This is the most speculative name on this entire list. Nauticus Robotics, ticker KIT, currently trading around $1 a share. I am including this name not because I think you should load up on it, but because I believe in educating you about the full spectrum of opportunity and risk in the market. Nauticus builds autonomous underwater robots with robotic arms that can operate at depths of up to 2,300 meters. These are fully electric, untethered machines that perform maintenance on offshore wind turbines, inspect oil rigs, and repair undersea communication cables. The applications are enormous. The technology is cutting edge. And if this company secures even one major contract with a global energy firm, the stock could move dramatically. But the reality is harsh. Revenue was only about $2 million last quarter. The company has undergone multiple reverse stock splits. They are in a cash crunch. This is a make or break year. In my entire career, I have seen companies in exactly this position either collapse entirely or emerge as dominant players in their niche. There is no middle ground. If you consider this name, treat it as a 1% speculative allocation at absolute maximum. Money you can afford to lose completely. Because this is frontier technology investing at its most extreme. Now here is what I want you to take away from today. The wealth transfer happening in 2026 is not random. It is structural. Money is rotating out of overextended large-cap defense names. The government is actively funding and validating new technology sectors. The FAA is approving pilot programs. The Pentagon is awarding contracts to smaller, more agile companies. The space economy is expanding. Urban air mobility is moving from concept to commercial reality. And the names positioned to capture this rotation are not trading at $500 or $700 a share. They are sitting under $20, waiting for the market to catch up to what the insiders already know. That is the exact setup I spent 4 decades learning to identify. But let me also give you the anti-trap warning that I always deliver. Do not under any circumstances, treat these stocks like lottery tickets. I have watched countless retail investors blow up their portfolios by going all in on speculative names because some YouTuber told them it was a guaranteed 10x. Nothing in the market is guaranteed. Diversification is not a suggestion, it is a requirement. Position sizing is not optional. It is the difference between building wealth and destroying it. If you want to invest like the institutions do, you allocate strategically. You size according to risk. And you have the patience to let your thesis play out over years, not days. So here is my question to you, and I mean this sincerely. Which of these 5 names resonates most with your investment thesis? Drop it in the comments. Tell me why. I read every single comment because this community is not about one person talking at you. It is about all of us building generational wealth together. If this breakdown added value to your financial education, smash that like button and share this video with someone in your circle who needs to hear this perspective. Next week, I am going to be breaking down the exact framework I used at JP Morgan to evaluate small cap stocks before they hit mainstream radar. You do not want to miss that. Subscribe, hit the bell, and I will see you in the next one. This is Marcus, and as always, invest with wisdom, invest with patience, and invest for the legacy.